All right, we are here. Welcome on in. This is Lowcountry Money Talk. We always have all kinds of things to talk about. Phil Bloyd is here, of course, with Revolutionary Financial Group, and it is always nice to see you.
Glad to be here, Jessa, ready to get going.
We got a lot to do. We got to get it going. We got to get talking because, you know, we like to kick this show off, Phil, for our viewers on current events and just sort of wrap up what's going on in the current economy. Lots to talk about, really, but let's start with gas prices because it's on everyone's mind.
Yeah, so gas prices are down a bit. I have noticed that oil prices per barrel are moving up. So I don't know how long it's going to take for that to catch up. But, you know, we're back in the 90s as we speak today, heading back maybe towards 100, but it's mainly because of supply issues now.
Right.
We did have the reduction in gas prices mainly because people weren't using as much gas.
Yeah, well, no,
So,
supply and demand.
You know, that could be good or bad because a lot of times when we're not using as much energy, that's a sign of a recession. So we have to be careful there.
Yeah, and you know, we'll talk a little bit about that because that's a big question, right, that needs answered, although some people really feel strongly one way or another. But before we do that, let's talk a little bit about what's going on in retail.
Sure.
Because it's hard to walk into a store right now and not notice some differences from what we've been used to for, you know, maybe the last decade or so.
So what I've noticed and what I've seen in some of the profit reports coming out, or earnings report on some of the retailers, it seems there's a move towards the discounters.
Yeah.
So the discount retailers seem to be making nice profits, but they're cautioning on earnings going forward in the next quarter.
Right.
So even though they have a nice report and the value of their stock you would think would go up, it could go down. And it's because they're looking forward. Some of the bigger retailers, maybe they over-ordered their inventory.
Yeah, it really feels like that because we got used to seeing the shelves kind of bare for a while there, and now they're overflowing in some of these stores.
Feast or famine, you know.
Yes.
So what happens? They ordered for the pandemic and all this stuff, and then all the supply hit them at one time, and now it's time for a big sale.
Now it's time for a big sale. So I guess that's what makes, you know, some of this forecasting not look so great for them because they're going to take that hit on all of those orders that hit the stores.
Well, the other thing, Jess, is in the reports that have been coming out, it seems that people are buying what they need. So they're not getting as many clothes and things of this nature and all that stuff.
Yeah.
know.
And when they do, they're going to the discounters. So that's what we're seeing. So does this mean we're in a recession, and what other factors are we looking at?
Yeah, I mean, I don't think we'll get any clear definition on that until after November, right?
Yeah.
It's an election year. But, you know, I just look at indicators. So if we look at a few indicators that normally look recessionary, first of all, I'm paying 30% more for some eggs.
Right.
You know, we were joking around earlier, and I said I go to the blood bank first, and depending on what the price and how many pints they get out of me, I take that and go to the store, and that's what I fill my bag up.
Can you get one carton or two?
I don't know. But so we look at that, and we're like, okay, the yield curves are inverted on the U.S. Treasuries. So the 2 years are yielding higher than the 10-year. So that's one indicator. We still do have the back-to-back negative GDP quarters.
Yeah, and by definition.
Lower energy prices. Okay, so that's 3. So, you know, all the indicators are pointing to that. The thing that's kind of holding people back is like, well, we really have a good job market, or, you know, you can go get a job anywhere, maybe now, but as I've been hearing this week, Ford's laying off, Tesla's laid off, the tech companies are starting to lay off, so I don't know how long that holds up.
Yeah, and that's what, you know, could be challenging for folks as we move forward. If the job market does get a little bit more challenging, it's going to be really hard to talk anybody out of thinking we're in a recession, because that's about the last thing to go.
Well, I may not be first in line at the blood bank anymore.
Exactly. Well,
it may go around the building.
When we return, for those of you who are in retirement or nearing retirement, we'll talk a little bit about what is going on and current events means for you and what you might want to do about it. All right. We'll be right back. Stick around. Okay, we are back here on Lowcountry Money Talk. Expert Phil Bloyd has stuck with us because we're going to answer some questions for you now, not just tell you what's going on. Phil, thanks.
Hey, no problem.
All right, so for our viewers who are watching who are about to retire, let's talk about them first, because this is an unusual time for folks and an uneasy time when you are about to enter retirement, when we're really, probably for all practical purposes, are in a recession.
Yeah.
So what does that mean? Any advice? Should we keep working? Do we just kind of delay that retirement or go ahead and retire? Pros and cons.
Well, let's go with the pros first.
Okay.
So if I keep working, I keep donating to maybe a deferred account, 401k, something like that. So I'll have more payments going in. Values on the equity side of the market are lower now, so you're buying into lower prices on your 401k, so that would be a benefit. Two, you won't be taking funds out of that, to live on, so that's a benefit as well. Inflationary, you're earning, you have your paycheck, you can kind of cover your bills with your earning income. If you don't hate your job too bad, and it's like, oh, I can't go in one more day.
That's a factor.
That's a factor. But if it's okay, and you by this time you've probably built a lot of seniority in that position, and you kind of get to come and go as you please. If you can stick it out a little bit longer, I would kind of wait and see how the economy goes, and keep saving, and I think you'll be in a much better position.
It sounds like a good idea to wait, but is there a downside? Are there any cons?
Well, I mean, the problem could be is if you delay retirement. A lot of people, they miss they wait and they work too long, and they have all these things they want to do in retirement. Leisurely things, I would say.
Right.
And if we delay it too long, sometimes we have health issues. And they come along, we work too long, and we don't really get to enjoy the retirement that we think, where we want to do some traveling because now I got to get a knee replacement.
Yeah, that's a
and
very
a hip
good
replacement,
point.
or got to stay close to the doctor's office for appointments. So that could be something too. So you got to kind of weigh it out.
Potentially.
Yeah.
Okay, well, no, that's a really good point. So for folks who are already retired, and this has been a tough turnaround because we got used to the ups of the market, and now we might have a portfolio with really down values, and we're not working. Okay, so obviously we need to be taking income from somewhere, go back to work, make some adjustments. What do you think?
Again, I would say the thing that is really tough and that we wouldn't want to do right now is to sell assets that are depreciated. In other words, the market's dropped and we lost some value, so if I sell it, then I'm kind of solidifying the loss. And then with inflation being 8.5% and eggs costing 30% more and meat costing 20%, so I'm going to be spending more to buy things, but with an asset that has depleted in value. So that's almost a double whammy.
Yeah.
So if I could get by without taking those withdrawals. Now, if I'm 72, I have to take withdrawals no matter what.
Right.
That's a whole different conversation. So let's say we're under 72 now and we don't have to take withdrawals, but we're doing it for income's sake. Maybe I would look to see if I could bear a part-time job.
And there's plenty of them right now.
Right now, they're all over the place. And believe me, retirees, early retirees, experienced, boy, this is the people that I would like working, very responsible type
reliable,
folks. Yeah,
absolutely.
They'll come to work, they have a work ethic. So I would take a look at that, at least just temporarily, if we could do it for 6 months or a year, depending on what happens with the economy.
Maybe at a grocery store, get a discount.
There you go. Well, at least, and in that way, it prevents me from withdrawing out of my, and it gives it time to recover. I think that would be a good idea.
Yeah, because we know we don't want to sell low. So anything you can do to avoid that. Lots more questions, and we have a half a show left. So we're going to go to break, we're going to come back, and we're going to ask Phil. We're going to get into the hard-hitting journalism here on the show. We'll be right back.
Okay.
Okay, this is the back half now. We've made it to the back half already. We went really fast.
Sure.
Lowcountry Money Talk. It really does fly, but we got lots to talk about and we have a lot of questions. So this is the hard-hitting journalism that I promised you here. We're just gonna kind of fly through some of these things because lots on people's minds. So let's talk a little bit about, retirement savings to start.
Sure.
I know a lot of people have this question. Is it invested appropriately based on your stage of life and your current economic challenges? How do we know that?
Well, if you're having a little heartburn now,
Yeah.
and you're worried about where your income's going to come from your retirement savings, maybe not.
Right.
What I have found, Jessa, over the past 12 to 13 years, we had this huge bull market surge. And so, as a normal person, we forget. We have a short memory. So I found that many people have become overly aggressive with their savings because, you get into that thing, it's never going to go down or this and that. So now we're having a little bit of heartburn, we're having a lot of volatility in the market, and it can cause major stress for retirees because, hey, we don't have any more income coming in.
Right.
So if you're having a lot of stress because of market conditions and things, maybe you're not invested appropriately, so we need to take a look at that.
Yeah, well, that's a good barometer. How much stress are you under financially? Maybe we've got to make some adjustments. Okay, let's talk a little bit about sources of retirement income.
Sure.
We discussed this briefly for retirees in the last segment, but let's talk about it more. How could they be impacted during a recession?
Okay, so let's say we have several income buckets. The better, the more the better.
Yeah.
We don't want too many holes in our buckets.
Right.
Probably none would be preferable, but old rusty buckets get holes. So let's say we have a Social Security bucket. I think we got a pay raise on Social Security this year. I'm not sure if it was 5 or 7%, so don't hold me to that, but it wasn't 8.5 or 9.
Yeah.
So even though we got a raise on Social Security, it didn't beat inflation. So we're still getting eaten away a little bit there. But one, we do have a Social Security bucket maybe. So we have income coming from that. Maybe we have a pension. So if I retired from the government, or I have some kind of what I would call the old dinosaur pensions where you get a fixed amount each month.
Right.
Okay, maybe I have something there. That's another bucket.
They don't do those anymore, not a lot.
Not unless you're a government employee or something like that usually, but maybe I have that. It may not have an inflationary factor, so that's going to be worth about 8.5% or more or less, depending on how many eggs and meat you eat. Right?
It's a good time to be a vegan.
You're right. Well, that's right. They don't have eat eggs.
Yeah, yeah.
Okay, so we've got the Social Security bucket. We've got the defined benefit bucket, which is the monthly income. Now maybe we have a bucket where we just keep money in the bank, emergency funds. Maybe that bucket's gotten a little bit too much in it.
Yeah.
So the inflation is going to eat that bucket alive.
Right, yeah, it is.
So if I have $100,000 in that bucket and I'm getting like nothing return on that,
Yeah, that was good.
by the end of the year at an 8.5% inflation, that's worth a little over $92,000.
Right.
So I lost $8,000. I didn't do anything.
Right.
See, that's inflation. That's how it eats you alive. So that could be a bucket. Then we have our investment bucket. And if we're all in growth equities and all this kind of stuff, that bucket is down, I don't know, market average 12 to 15% or so, 12 to 20%, something like that. So that one, so if I can do something with the one bucket that's in the bank and maybe I have too much in there or something, I probably need to start getting some return on that.
Right.
That would help a bit.
Right.
This bucket is depressed because the market's down. I would prefer not to fool with that bucket much. So it depends on how your buckets are.
It's very individual.
It's your bucket list.
I actually am making notes. I have drawn 4 buckets with some notes here. But the point being, you really need to take a look at everybody's individual situation.
Right.
What you have in these different buckets and where to pull from. So if that's you and you're thinking maybe you want to get that taken a look at, you really do. It's great to have professional advice. Rachel over at the office there can help you with that. If you want to get a portfolio analysis and a risk assessment, just get started and
Sure.
see where you are.
Right.
That might be a good thing to do.
Always good to see where you're at.
We got plenty more questions to get through in one more segment, so we hope you'll stick with us. We've got Phil who's going to answer them after the break. Okay, we got a lot of questions to get to quickly. I'm going to dive right in. Phil Bloyd has returned. We're going to rattle off a few more for you,
Sure,
Phil.
let's have
Sound
them.
good?
Yeah.
Okay, the big one. I think this might be the most important question we asked today. Has your broker or your financial advisor recently provided strategies to really recession-proof your retirement? This is huge,
Yeah.
a huge question. If they haven't, this is a very big problem.
Yeah, well, a lot of advisors take the summer off.
Yeah.
Okay, so maybe we should skip taking off this past summer, but it's almost over, so, whatever. My thoughts would be is you need to get in there and you need to get some fluid answers on, because a lot of times the easy way is say, oh, well, it'll be fine and we'll just, weather it out. And this, I mean, Jess, I don't know if I would take that answer.
Yeah.
Okay, so the idea would be our economy has shifted, it has changed, we don't know for how long or anything else, but what strategies do we have? How do we need to adjust? So if the economy's changing and we don't adjust our holdings, I mean, I don't know. I would think that we would need to adjust some things.
Right.
So typically one of the things that I look to do is, as we mentioned about the buckets, we definitely want to stop withdrawals from the equity side of the portfolio. So we should have something to back that up. A lot of times in our previous programs, we've talked about a bull bear IRA strategy or something like that. Even if we don't have an IRA, we could still employ the bull bear strategy. And the bear strategy says when we're in a bear market, we have a place that we can take income from that the asset will not decrease in value because of market fluctuations.
Right.
Now, whatever that is for you, I don't know. There's several choices out there. Talk to your broker. But you may want to talk about if you're taking income out of your portfolio, one, do you have too much maybe in your bank bucket, and maybe you can stop taking from your investments and shift to the bank bucket and take some out of that till you have 6 months expenses is what you really want in your bank bucket. So that's one thing you could do if you're under 72. If you're over 72, really you should have that bear IRA strategy that in a bear market where you can take withdrawals but not take them from your equity growth side of your portfolio. So
Yeah.
these are the questions you need to talk to your advisor about. So.
We've got them on screen for you. It goes so fast. There's one I'm going to skip down because I really want to talk about the bear market trap.
Okay.
I'm not familiar with the term. What is it, first of all, if you can answer that
Well,
quickly, and how does it relate to risk?
There are rallies in a bear market. So even though we may be in a bear market, you'll see rallies come up inside of that,
Right.
and then go back down, okay? But the bear trap will be that the stock market index gets a signal that's wrong and it drives the index up, and you're thinking, hey, you ever watch Jaws? Okay.
Yeah.
It's like, it's safe to go in the water,
Right.
and then a big great white rips your leg off, okay? So we've got to be careful with these fluctuations and these bear market traps. No one wants to get stuck in a bear trap.
No.
You're from Minnesota, right?
That's right. It's
There's
not
a lot
good.
of bear traps, so you don't get stuck in a bear trap because it'll take your ankle off or your leg or something. So be careful, because a lot of these rallies may be on information that's not exactly frugal or was not correct. We'll
Not
just use
correct.
that.
Yeah, unfortunately, that's true. If you want Phil and his team to take a look at what you have going on, you can call Rachel. She'll get you set up with a portfolio analysis and a risk assessment. And somehow, Phil, you managed to make a bear market fun. I don't know how you do it, but
We've got to have fun.
it is.
Lighten up. Let's have, things will change eventually. We just have to be smart about it, get through it, and, then we'll get back to a nice, solid bull run, and you make all kinds of money. Right?
Then we'll really have fun. Okay, until next time, this is Lowcountry Money Talk. We'll see you then.